Where do you think rates are going to go now? Of course they're going to go lower. They're going to go lower soon. And if the Fed doesn't lower them soon, they're at risk of a massive policy error. So they got to pull them down quickly here. In my opinion, they're going to come down over 1% in the next 6 months, at least. The 10-year US Treasury. That rate basically is what all of other things key off of. Credit cards, personal loans, HELOCs, mortgages, auto loans, they all key off of that 10-year. So even if there's inflation, that rate needs to be kept at a level that doesn't crush the consumer. If this 10-year goes from 4% to 6 or 7%, it's game over. But they also know that if they let inflation run hot, this rate will naturally go up.
You opted out of the broken financial system by adopting Bitcoin and taking self-custody of your money. But protecting your wealth is only part of the equation. Now it's time to protect your freedom. My family is stacking sats and stacking flags. A second passport is our hedge against government overreach and uncertainty. If you're a Bitcoiner looking for your exit strategy, our friends at Citizen X will help you secure second citizenship through investment or descent. Book your free call today by hitting the link in the show notes or simply scanning the QR code on the screen. Let me break this down for my fellow Bitcoiners. In just 8 weeks, I've seen a serious shift. More strength, more energy, and fast muscle gains. The reason? FITSCRIPT. They ran 124 biomarkers, blood, hormones, inflammation, and built a fully custom plan, nutrition, training, supplements. No guesswork, no templates. This is functional medicine meets precision fitness for high-performing men who want sovereignty over their health. If you care about optimization the way you care about your money, test, don't guess. Don't trust, verify. Hit the link in the description or scan the QR code on the screen to check out FITSCRIPT and see what's possible. For those unfamiliar, can you, I guess, explain a little bit in regards to the dynamic of, the overnight rate and shorter, shorter duration versus the long duration and the risk and reward, like when somebody looks at a 30-year and they say, I'm going to get X amount, but they're looking at the inflation rate and the real inflation rate. What is the dynamic? What is the thinking there? And what is the consequence of them not being able to sell long duration bonds to people because they don't see value? So sorry, that's a lot there, but
no, that's a great question. So basically the way you look at it is that if you plot the yields on a curve, right, you say that the Fed funds rate starts here, and then you got a 3-month, a 6-month, a 1-year, a 2-year. The curve should look like this, right? It should go up and to the right, and you should be compensated in a normal, healthy economy. That's what it should look like, because you're going to be compensated on the long end of the curve for risk of holding that bond and there being inflation in the future, or a much larger issuance of those bonds because of deficits and the government having to just flood the market with these bonds. So, that's just pure supply and demand. If there's more supply, it overshoots the demand, and then you've got people demand a higher rate for that. They want to be compensated more for holding this bond. That's normal, right? Well, in a situation like today, and the Fed only controls this little dot down here, which is the Fed funds overnight rate. And everything is kind of keyed off of that at the short end of the curve. Bank rates, money market rates, what you're getting in your Fidelity or your Schwab account for cash, that's keyed off of this rate. But what's not keyed off of that is the 10-year. And the 10-year is the global reserve asset it's the global reserve asset. It's a 10-year US Treasury. And that rate basically is what all of other things key off of. Credit cards, personal loans, HELOCs, mortgages, auto loans, they all key off of that 10-year. And so that is the rate that they need to keep under control to not kill the consumer. So even if there's inflation, that rate needs to be kept at a level that doesn't crush the consumer. If this 10-year goes from 4% to 6 or 7%, it's game over for the US consumer. They know they can't allow that. But they also know that if they let inflation run hot, this rate will naturally go up, because you've got bond investors are saying, I need to be compensated more, because if inflation is now, if we expect inflation to be 7, 9, 10, 12, 15% in the future, I can't accept 4.5% for this rate. I need 6% or I need 7%. And so they've got to make sure they keep a lid on that in order to make sure that the borrowing doesn't get out of control. Because if that, you have two things happen: the consumer gets crushed, and then the interest on your debt gets out of control, because now you've got a problem here where you're not paying $1 trillion of interest, you're paying $1.5 or $2 trillion or $3 trillion on interest. It just spirals out of control, which is what Brandon was saying. They can't let that penny get closer to the bottom of the bowl. They got to like tilt the bowl back up and get it back up here, slow it down a little bit. How do you slow that down? Inflation. And you just allow it to keep circling the bowl, And at the same time, it crushes the smaller income people. There's a measure here that shows, this is the white line here is what is calculated as the neutral rate. What Holston, Labick, Williams, it's a calculation that determines what they think the neutral rate is. What is the neutral rate? Where if Fed funds was at that rate, then it would not be restrictive and it would not be expansionary. It would be right on target, so it wouldn't impact the economy either way. If you look at the neutral rate over the past, just call it 25 years, look at how often it has the Fed funds rate has been under the neutral rate, meaning it's been expansionary all this time in the early 2000s. And then it got up there just a little bit, just for a little bit in 2007. And then it dropped and stayed under. Look at how long it's been under the neutral rate, meaning it's been expansionary all this time. And what do you think happened with assets and the S&P and gold? And then, of course, Bitcoin was born in here. Great timing for Bitcoin to be born, because this is expansionary, meaning that the U.S. money supply, basically, in debt and leverage, expanded this whole time, all the way through here. And now it's been above this neutral rate now for a little while here, for about 2 years. And it's time for them to bring this back down. And they know they've got to bring this back down, because otherwise they're going to drive it into the economy into the toilet. And so that's, into the gutter. And they don't want to do that. They know they really can't do that. So look at how often they've allowed it. Where do you think rates are going to go now? Of course they're going to go lower. They're going to go lower soon. And if the Fed doesn't lower them soon, they're at risk of a massive policy error. So they got to pull them down quickly here. In my opinion, they're going to come down over 1% in the next, 6 months at least.
Hey, you. Yes, you watching the Bitcoin price movements and the latest exciting news. It's awesome to stay informed, but the real power of Bitcoin comes from taking control. Don't just watch, take action. Head over to btcsessions.ca/learn for free step-by-step tutorials that guide you through every major skill you need to know, plus full video playlists for deeper dives on any topic you like. And if you're ready for the ultimate fast track, scroll to the bottom and check out bitcoinmentor.io for premium one-on-one experience with my team of Bitcoin experts to ensure you get it right the first time. Don't wait. Secure your Bitcoin future today. Hit the link in the show notes or scan the QR code on the screen.